Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry, and no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
It's Sunday morning. This time around, I skipped the Saturday recording. So, welcome back for another weekly market recap. Um, Pretty much a flat week, both from the price action standpoint, mostly, I'd say, overall, right, for the broad market, and from the standpoint of the economic calendar. Which, if we just check briefly, there wasn't a lot. A few bills and treasury auctions from the US government, and the usual jobless claims on a Thursday. But other than that, it was a relatively calm week from a fundamental standpoint. So what I would say is let's jump into the charts right away, and then we might take a look at a few interesting things. Or I got a few slides to be fair. Now let's start out with the DXY. The DXY had this little bit of a bounce throughout the week. It's nothing major, really. We are just, doing the same thing we were doing before. So lower highs, lower lows, price goes out, comes back in, right? Your usual extensions, extension fields, and whatnot. Does it change a lot in the grand scheme of things? No. I mean, the trend, it's still the trend, as you can see over the last, what, it's the end of March, so 2 months, 2 months and a half, more or less. So nothing new in the dollar or again the DXY. We are testing the previous base, which was broken, and even if it keeps on going to the upside, we got another level right here, and I would say another one right here. The fundamental case, again, as we highlighted 1 month ago, for a potential counter trend rally at a point in the DXY. It's still, it's still there. Nothing really changed from the sentiment to the positioning. But I would say, as we established, you need a trigger from a technical standpoint on the chart, right? So for now, it's still drifting to the downside. And remember that when you see an asset, whatever asset, which is slowly and orderly drifting one way or the other, that's not really the type of market you want to try, to fade if it's going to the upside, or to, time the perfect bottom if it's going to the downside. Like in this case, it's way better to wait for at least a shift in the current order flow or market structure before getting too excited about a potential reversal. And even then, remember, markets can have counter trend rallies and all the rest, but in order to really see if something really changed, you might need to check the higher time frame type of trend or structure. Like in this case, if you remember, we went over the monthly time frame for the dollar, right? And although it has been particularly bearish over the last, well, basically all the year, right? It started collapsing when at the beginning of March, end of February. So, this is one of the biggest drop on record for the DXY, I guess 10%, something like it. But, if you zoom out enough on a monthly time frame like this, what you see is that, well, at the end of the day, it's still on a macro scale a bullish trend. So it depends on how you look at things, right? So just bear in mind there is always another perspective. Conversely, of course, foreign currencies had a little bit of a pullback, like the euro pulled back a little bit, the British pound pulled back in a more substantial way. You can see is a much deeper type of a retracement. Uh, the Do you remember we were talking about? Look, if you see the DXY rallying and if you see the yen rallying against the dollar, that could be a very ominous sign. Looks like we are safe from that point of view right now. The dollar actually rallied against the Japanese yen this week. It basically rallied against everything. So yeah, that's cool. What else? The Swiss franc just went sideways, but again, it's always the same thing, right? We got a very nice extension to the upside, so it's natural that markets they just don't go in straight lines, right? And the Canadian dollar, it pulled back from the level we were looking at. It bounced, and then it's still tapping into that same level and consolidating right below it. So what can you infer? Well, I mean, consolidation below previous resistance, it's good. I mean, we tested it, we were rejected, but immediately we reapproached that, and now we are consolidating below it. Usually, when markets do something like it, it's a bit counterintuitive in my view, and that goes for every single market, not just this one. But people tend to look at it like, you see, that resistance is particularly strong. It's been rejecting price 2, 3, 4 times in a row. Reality is that liquidity on the sell side in this case, it's just being eroded, and sooner or later, the weaker the rejection is, while you go ahead with time, the higher the odds that at a point price will need to seek liquidity above it. All right. So that would be it for major currencies. Let's have a brief look at the rest of the spectrum. Nothing really huge, even in there. Yeah, I mean, I guess the charts they just speak for themselves. Uh, yeah, sideways more often than not. There was this huge spike in the ruble against the US dollar on what was that? Guess it was a Thursday maybe, and then a sudden pullback. But again, it's not the most liquid FX pair, right? So I don't know how much you want to read into it. Let's move into oil. Oil again, it's still slowly grinding to the upside. It looks like, at the end of the day, these previous resistance, which was broken with the issues in the Middle East, has been now retested. The initial geopolitical premium evaporated. Yeah, that's true. But at the same time, we retested that area. We consolidated a little bit above it, and then we broke out of that tiny short-term range. We retested it once again from the upside, and we bounced. And then again, a little bit of a pullback and a bounce, and we closed the week with a little bit of a strength. It's nothing really humongous, but still the market is slowly trending or grinding to the upside in this case. Um, it looks to me like we want to establish a new dealing range. It could be in between, again, as I said, the 65, 66, potentially the 70s. That would be, in my view, some sort of a sweet spot, if you wish. It's like your usual shower, right? Where the water needs to be not too hot, but not too cold. So in this case, as for the oil, if you want to drive the parallel, price is being just in the sweet spot, not too high that it starts to break things, like generating inflationary pressure, or spooking the markets out for potential Fed cuts postponing. Although that is a whole separate topic, I guess, which is always particularly actual, but I'm not gonna go into it right now or today for what matters. At the same time, these range in between, again, the 60, 66, 65, and the 70s. It wouldn't be too low as for, major companies which are active in the mining, or how do you call it when you seek for oil in the ground? It's not really. Is it mining? Maybe more of a extraction, right? Yeah. So these extraction companies, they could still generate a little bit of a profit. Although, I remember the break-even price of oil for mostly US based companies, it was a bit higher than that. It was more in the low 70s, mid 70s, but I guess it's still better, right, than having oil below 60 as it was, let's say, in May, right? That's really what puts these companies at risk, or at least it puts their revenues and their earnings at risk. So as for now, I am not reading a lot of potential risk coming off of the oil market, but we just had a major expansion in volatility due to events in the Middle East. But uh, as soon as it starts, no, should I say, as long as it keeps being relatively calm like this, I wouldn't read a lot of potential risk into it. Right, let's settle this up this way, right, for the time being, and we are gonna monitor it week by week. All right, let's have a look at Bitcoin, which is the market which shines the most for now. So new all-time highs. Do you remember last week we left it where what? It was, I guess, right around here, right? We finally took out that previous level. We consolidated a little bit in this new and very short-term dealing range, but it was enough. Like if you start to imagine like this now, you just shift this line to here, right? You see, it's just started stepping to the upside. It took the high, it pulled back in the previous shelf, which was built up, and then it just ran to the upside. So new all-time highs for Bitcoin, which again, all cool. I mean, if you look at it as a proxy for risk on assets, or at least as a measurement of risk appetite in broad markets, that should bode well for the overall market in general, right? At least, if you're approaching it with some sort of a bullish lenses, right? Now, again, I don't have specific targets to the upside for this one. You've seen in the past when it starts to run, it's always hard to predict where it's going to stop. Now, I guess many people would use what could it be some Fibonacci's extensions and whatnot, which I guess it's totally legit. I didn't take the time to do that this time around. Quite honestly, I never do it. To be fair, my philosophy when you got a market which is making highs after highs after highs is always, you know what? Let's wait for a top, even if it's a short-term top, but let's wait for a local high to be put in, to be confirmed, an apex to be formed, and then we reassess what it could be in the near future for that specific asset. So like in this case, up until the point it runs, just let it run. I I had this conversation right yesterday morning. I was messaging and exchanging audio on WhatsApp with a friend, and he was like, "Yeah, this market has been kind to me. I've been long for over the last few months. Now, after we breached new all-time highs, you know what? I just took profits on my longs, and I opened up a short position." And I asked, "But look, why? What's the logic of it?" "Well, you know what? It made a new high, so next comes the pullback." Yeah, sure, but price is now around 112K. Yeah, we just breached new highs. You don't know where the pullback is gonna come from, right? Or when. So, rule of thumb, mate. If the market is making new all-time highs, usually new all-time highs bring to new highs, not a reversal, not necessarily, and not right away. Why would you want to short that? I don't get that. But that's just what we do, right? And don't get me wrong, on a very smaller scale, right? I'm guilty of that too from time to time. I see the Nasdaq kind of dropping, and I say it's quite funny because it happened to me right this Thursday. It was a very bad day this Thursday. The market opened with a sudden drop from the open, and I was caught offside three times at the end of it, trying to time the bottom. It was a very bad day, especially from, it wasn't that much about the monetary loss, but it was more about the framework and how you read and interact with the market. It's dropping, right? Yeah, just fucking wait for it to bottom out and start to reverse. And it's easy for me to say in hindsight right now, but nonetheless, I was the same dumb fuck which lost a bunch of money just trying to time the short term bottom for the session. And it didn't work out well for me. So, yeah. And it's the same for these type of assessment right here, but the other way around. Why are you trying to time the top? And of course, 2 3 days later, I guess my friend either was closed down or closed out of his short, or he is suffering a massive pain. So again, for now, Bitcoin up until it runs, let it run, right? Let's move on to gold. It's still gold. It's resilient enough, right? There was this day, which basically was on Tuesday, where we closed below this trend line. Although, if you look at it, it was some sort of a joke when I drew it for me, because I don't use trend lines a lot. I was, maybe you could say, I was poking fun at people which are using them. Not necessarily. I mean, it's just, if you want to look at them as a regression line, so be it. Be my guest. It is useful, as you can see, but I don't necessarily use them. And there was this day where we actually closed below it, right? Assuming, this is the right way of drawing that, I'm sure the diagonal trend lines junkies could come at me and criticizing how I drew it and all the rest. All good, right? That's what a market is for, right? Different opinions. That's what makes a market. But my point would be, even if you assume it was drawn correctly, we bridged it briefly, but then again, just to highlight another point, which goes for trend lines in my view, and also goes for moving averages if they're using them. One close above or below it doesn't really tell you the whole story. What you would like to wait for, or at least the way I do things, because I do want to trade on confirmations. Uh, Usually, unless it is last Thursday, right? But but you would need an open and a close below it, potentially a retest of the level and a confirmed rejection, right? While in this case you didn't have it, we have the drop, but it was very short-lived, and then immediately Wednesday, Thursday, and Friday, we kept on rallying. It's kind of the same scenario we have seen in the dollar Canadian, right? We got support, broken, retested, resistance, rejection, but the rejection was particularly shallow, and we reapproached the previous resistance now. The previous support now turned resistance. 1 2 times. Might it be we stall a little bit, or maybe we pull back even more, or another time, but again, shallow type of pullback, and then on the third time we reapproach this area, we kind of breach it, and we keep on going. Well, at that point, I should say, toward the highs, right? uh yeah, I mean, if I had to bet on anything, I would bet on that before betting on a full-on reversal right here. But I still do like to entertain the possibility that this is the type of market which can stay a bit choppy in a range for a while, working off the overbought conditions. I would favor the bullish side of things, of course, because of the chart, because of the fundamentals and all the rest. But just move on your invalidations level at this point. So it was this one right here. I guess in another 2 weeks we could move it up to here, assuming the market keeps on rallying or at least grinding to the upside. So again, nothing particularly new on gold overall. Still think this market, it's in a bull market, and I wouldn't be in a hurry of liquidating my position, or God forbid, shorting this market yet, right? Let's have a look instead at the yields and the treasuries. So yields came up this week. They started out on Monday, basically. There was a little bit of a pullback. Funnily enough, on Wednesday and Thursday. Wednesday and Thursday. That was right when we had those auctions. We got a 10-year auction and a 30 years auction this week, if I remember correctly. But I guess most of it, it's. I mean, I'm not totally sure, right? You can't ever be sure about anything. You could just try to scramble for justifications, right? Or rationalization. This is what we do as human beings. But I would say, don't discard the fact that we got the BBB, the big beautiful bill, actually passing this week. So it might be that the bond market it's having some sort of a knee-jerk reaction because 5 trillions additional deficit, this is going to be inflationary, or this is going to project the or send the message out into the world that we are not going to stop issuing debt, and therefore the rest of the world will demand higher yields in order to buy our debt. Yeah, yeah, it could be a narrative, I guess. I wouldn't rule it out, but at the end of the day, I still think we are just chopping around, and we've been chopping around for basically what, almost 2 months now. Um, Fundamentally, if you zoom out, let's say on a weekly time frame, this is what you see again. So the short end being a bit weaker, the medium end being basically in a range and in a consolidation, the long end still being a little bit more bullish. But I don't. I keep on not trusting these divergence we see, and at a point, I guess you know one of the two ends needs to be right. So you're gonna see at a point all of them trading in the same direction. That's what I would say. It's not the time yet, but from a macro standpoint, I guess yeah, divergences they can go along for quite a bit of time. And I got another shot, but that's for the equity market. But still, it's about divergences. So they can last a lot, but eventually they need to resolve themselves one way or the other. So one of the two, which is diverging, needs to be right, and the other one needs to catch up. Right? We'll see. We'll see how long it's going to take. All right. So conversely, if you look at the bonds, and we are looking at the futures, so the T note for the 30 years, the T note for the 10-year, and the T note for the 2 years, they are basically reflecting what we have just seen in the yields. Now, since I hinted at that, and from time to time, I would like to dig a bit deeper into what I mean when I say, or when I said in the past, look, everyone is keeping on this narrative that foreigners are not buying our assets or our debt in this case. China is dumping, Japan is dumping, major bag holder of US treasuries are dumping their treasuries and they are rejecting uh, the US dollar or the US debt and whatnot. So again, might be true if you want to believe that. I don't think so. And I'm going to explain to you one way by which you could verify it. I just need a few moments to review tiny notes that I took in order to make sure I can explain the concept of the best of my abilities. But yeah, I think it might be a valuable information to have. So bear with me for a minute or two, right? So let's have a look at a few slides right here. Okay, so this is basically what you might find on the internet when you want to check the results of a treasury auction. And in this case in particular, I was able to find a recent one, I guess, because July 8, 2025. So this is, I guess, yeah, a 3-year note auction, relatively new. So I know when you look at it like this, doesn't make a lot of sense, does it? But there are a few informations that you can grasp from it. As for did the auction went well or go well, or did it go wrong or badly, right? Now, instead of looking at this document, let's just jump into what all these numbers and acronyms might mean. Okay, so let's have a look at these. And this is pretty easy to do, but you can just ask. In this case, I just asked Grok what was the meaning of it. So you got a few metrics in here, right? So auction yield versus when issued, aka WI yield. So as you can see, these treasuries or these assets, they are issued first and then they are auctioned, right? So in this case, this is just the difference of the yield in between the moment the assets are issued but not yet auctioned, and the yield which you get on this asset when they are actually auctioned. And as you can read in here, if the auction yield, so the moment when they are allocated to the overall market is lower than what it was when they were issued but not yet auctioned, that shows a strong demand for the bonds. If instead the yield when they are auctioned is higher than when they are issued, that shows a weaker demand. Now, this is the only one type of a data that you're not gonna be able to grasp from it. Okay, you would need to dig a bit deeper in all the data sets and whatnot. But as for the rest, you got your bid to cover ratio, which is pretty simple, right? It just shows you how many offers or bids in this case. So how much demand, right, was placed or was manifested, and it compares that with the amount of demand which was actually met. So the bids which were actually accepted. Okay, so of course, needless to say, the higher the ratio is, the more demand there was for this particular auction, right? And you can grasp it basically by dividing this subtotal right here from this other one. So you can see the tendered, which are just the bids, right, in this case, and the accepted. And we are still talking of bids, right? And then what we got is going down primary dealers, right? I guess this is another thing which sometimes people tend to forget. It's particularly difficult for an auction to go kind of empty, right? These primary dealers are just 24 huge banks, right? And they have to buy the treasuries. Otherwise, they won't be primary dealers, okay? So you can't say nobody's going to buy the debt by definition. Now, I know you could go off with many other different assumptions depending if the auction is actually good or bad, but the fact that an auction could actually see no one bidding, to me, it doesn't exist because these are banks which are forced to bid. All right. Otherwise, they lose their status of primary dealers. So they are just making the market. They're just market makers for these auctions, so to speak. So it's one thing you can look at. If the dealers are taking on a smaller and smaller portion of the amount of treasuries or bills which were auctioned, that means that other investors are actually buying more. So there is more demand from the overall market and the general public for these bonds. So the the lower the number in here, the better it is as for assessing if the auction was good or bad. Okay, and then you got direct and indirect bidders. Pretty straightforward, right? Direct bidders, it's those which are buying bonds directly from the treasury. And that can include the primary dealers, which are, guess what, buying them for themselves and not to then, allocating them to clients or to trade them. Now you might wonder why a primary dealer would buy at the auction and then keeping the treasuries for themselves. Do you remember when we discussed last week that spike in the repo market, the potential collateral shortage and whatnot? Primary dealers are still banks. They operate in the interbanking system and the euro-dollar system. So whether you believe it or not, they need to shield their balance sheet and they need to generate potential future returns. So again, if they see an opportunities or potential arbitrage coming in, they, instead of reallocating the treasuries or the bills that they just bought at the auction, they might decide to keep them to themselves and then making business in the repo or the reverse repo market for a profit, capturing some potential spread here and there. Right? So then you got indirect bidders, which again are all of those which are not buying from primary dealers, but are buying directly from the treasury, right? Now that you got all of these in mind, let's move on to something which might sound complicated at first glance, but trust me, it's not. So what you got here, it's basically some sort of a recap of how the current auction went. So I took a few notes because there was no way my tiny little and stupid brain would be able to remember all of this. But in a nutshell, the blue diamond shapes or symbols, if you wish, those are the current read for the current auction, or the latest, the nearest auction we had. Now, this is relative to the 10-year auction, okay? And all the rest of the data which this blue diamond is compared to, it's basically the last auctions, 50 auctions in this case. So what you see then is these colored rectangle, it's basically the range where the 50% of distribution of the previous data set, again, previous 50 auctions, actually fell into, okay? It's some sort of how would I call it? Basically, the half of the previous data among these huge data set fell into this range, okay? Then you got the line in the middle of the colored area, which is the average, right? So you got the 50% range and the average overall of the previous 50 auctions. And then you got some sort of a measurement of outliers, if you wish. So you see these huge ranges, this one, or this one, or in this case, this one, this one. So you might call it the tail end or the outliers of the data set, because that is just what highlights the best 25% of the data and the worst 25% of the data. So if you are familiar with the concept of standard deviation, I know it's not exactly the same, even with my low skills in math, but it kind of tells you the extremes, right, of the range as for the data set you're looking at, which again, last 50 auctions. So when you look at this, right, what you see is that currently, right, as for the latest 10-year auction, and let's go down now, the yield at the auction was 4.362%. Okay, so about a third of a basis point below where the bond was trading in the, again, when issued type of market. And if you remember, if the yield at the auction is lower, that shows strong demand. All right, check. Then what you look at is the bid to cover ratio. The bid to cover ratio, as you can see, it was in the high side of the 25% type of a best and worst case for the data set. And it was higher, or at least it was above, the 50% range of the data set. And it was, of course, higher compared to the average. Okay. Then you got direct bidders bought a higher percentage of bond in this auction than in the last 50 auctions. So investment funds took down the second highest allocation of 10-year notes on record. And you can see it in here. You see the direct bidders? Where are they? Yeah, there you go. They are right at the edge of the 25% best data, above the average and above the colored range and all the rest. And so if you look at the primary dealers instead, they took down a below average portion of the bonds auctioned. And if you get back to it, if the primary dealers bought fewer bonds, it means that other investors are buying more. So this 10 years auction, it went particularly well. Now, if you remember, it just go backward in time a few months or a few weeks, and you should remember the US debt downgraded. Nobody is gonna bid for a debt. The world is rejecting US debt. Is it? Is it really? Doesn't look to me, especially when you consider that bad auction, it was a 20-year auction, and a 20-year maturity, it's what by definition it is an orphan maturity or an orphan type of treasury, because it's not that relevant, not as much as your 2 years, 10 years, or 30 years, right? So again, over time, when you look at something like this, you see that the bid to cover ratio, yeah, it was kind of going down a little bit from 2008 to 2018, and then it kind of bottomed out, and it looks like it's starting to revert the trend. Okay, and again, bid to cover ratio, the higher it goes, the more demand it shows for the underlying asset. And the primary dealer takedown in percentage terms, it's going down. It's been going down over the last 15 years. So again, if the primary dealers are taking on less and less, that leaves more space for other type of bidders. So again, just to show you that this narrative about the world rejecting US treasuries and US debt and the US dollar, it's not rooted in our data at the end of the day. So I mean, you keep on thinking whatever you want, but these are the data. Now, again, if you want to keep on saying, but the data are cooked, the treasury is lying, and all the rest, fine. Point is, I'm the first one which says, when they come up with the CPI, it's probably cooked. Probably the CPI from the BLS, it's massively underestimating or understating the real rate of inflation. Yeah, whatever. The market will move on that particular data. Doesn't care if it's fake, if it is cooked or whatnot. So I mean, if you engage in markets, just bear in mind the market will move and will react to the headline. Okay, so that was it for closing down the bonds and yields topic for today. So let's have a look at what happened with the equity market. So Monday started out with a little bit of a drop, particularly sharp in the S&P, not as much in the Nasdaq, but the movement was pretty much the same. It was particularly exacerbated in the Dow as well. Then, we spent Tuesday, Wednesday kind of reaccumulating, ranging. The market was a bit choppy. It wasn't the best week ever. And then we got this massive surge, which is, I guess, New York session on Wednesday. Yeah, yeah. But even this one was quickly faded. Now, this was a nice day, very volatile, massive expansion to the upside, but then we ended up the day pulling back a lot. On Thursday we bounced, of course. We tried to go for the highs once again, and that was interesting. Although I did my ass on Thursday, but nonetheless, let's review that. You see the on Thursday the S&P, it's taking out the previous daily highs, while the Nasdaq is not. So again, what you see after that, it's basically then the Nasdaq dropping like a rock, and this is basically where I was caught. All right. No, actually, no, I was caught in this segment right here. Yeah, yeah. I remember I started to try to long in here because I was like, you know what, we are retesting the London Open, the European Open area. We might see a little bit of a bounce off this area. No, turns out I was like an hour and something earlier in that trade. And we were, in hindsight again, but the market needed to go down twice as much before actually pulling back and bouncing. So, it's going to happen from time to time. Can't always win in these markets. So the week closed down with the market staying in a range, more or less. And if it's much more evident if you start to zoom out on a daily time frame. Now, is this good? Is this bad? It is what it is. If you remember, we were looking at it even the previous week, and we were looking at it from the standpoint of, look, the market is particularly extended. We got 2 weeks of up only, so it's natural that at a point you need to wear off to work out that overbought condition. And there are just two ways you can do it. You can either have a pullback or having the market consolidating while oscillators and indicators are resetting themselves, and moving averages in this case are catching up with price. Now we are still fairly deviated from, in this case I used the 55 exponential in green, but you could also look at the 50 simple moving average in red. So, you see that even in the past, when we deviate particularly away from those core moving averages, we tend to mean revert toward them. So, look, is the market in danger of a sudden pullback? I guess it is in the possibilities, right? especially if you consider that uh, we are now entering, at least we could enter a phase where seasonality is not particularly strong, especially August and September. Um, there is a lot of very bullish sentiment in markets right now, and you remember last week we were looking at the proliferation in the use of option trading, but same goes for leveraged ETFs, right? There is a lot of risk appetite, and it looks to me like the market got a bit in complacency at the current moment in time, and that plus the technicals, could this be a good time to consolidate a little bit, or even potentially pulling back? How much? I guess, it would be disingenuous and not really useful to say, oh, I'm expecting a 4, 5, 7% pullback. The problem with predictions, in my view, is that when you come up with a prediction, you need to have a time frame for it. Like, I'm expecting a pullback in the next 2 weeks or a month, what have you. I'm expecting this pullback to be in this range. So, I don't know, 4 to 5%, 7 to 8%, what have you. And this is how you can position yourself to benefit from it or to protect yourself from it. If you can outline something like that way, now it becomes useful. Otherwise, you fall in the categories of all those people being perma-bear and saying, yeah, I'm expecting a 50% drop. Yeah, it's been since 2008, and we never ever had again a 50% drop. Even COVID, it was what, 35 something. So again, this is why I'm not trying to predict what's going to happen. I'm just trying to outline potential risks and if these and that type of scenarios. So I think for now the market it's cool enough. I mean, it's not in danger of having a huge drop. Problem with these is that you could wake up on Monday morning, Trump comes out with a very sparkly declaration or a post on Truth or Twitter or whatever you, and the market is down 3% in a day. At that point, you should drastically change your outlook if you think that what have been said actually changes the fundamentals, right? Even in the short term. And if you pair on top of it that the market is particularly complacent right now, you know, that's the risk you are trying to assess at the current moment in time. I would say, in order to have a little bit of a tangible and actionable type of plan, look, as for the ES futures, previous weekly low, right? Up until the point it stays intact, we are cool. 21 exponential moving average, up until the point we can maintain it, we are cool. If we lose it, we might really pull back to the 50 simple or the 55 exponential, right? Try to establish triggers and lines in the sand, right? And then you can start to say, you know what, maybe I don't want to wait for it to unfold itself. Maybe if I was invested for the majority of this rally, this is a good time to trim some position off, take a few profits, building up a little bit of a cash in order to potentially actually being a buyer if we got a dip, right? Um, all in all, again, I don't think there is a huge risk for markets in the sense of having the bear market types showing up their ugly face again. But I think all things considered, the market could be at risk of a potential pullback. So although the chart doesn't suggest that you should completely sell all of your positions or going short, I would advise against it, to be fair, up until the point it's the same type of logic I was laying out for Bitcoin, right? uh, but it wouldn't be a bad time to kind of the risk, take a bit of profit, especially if you got positions which performed particularly good, right? Just trim them back to your target ratio in your portfolio. It wouldn't be bad, right? Nobody ever went broke taking profits or making money, right? So that plus and I'm sorry I didn't have the time to pick up the slide, but if you look at the high beta stocks and the low beta stocks, the high beta right now are completely overbought, if not for maybe Tesla, I guess, and the low beta are particularly out of favor. So at a point you're going to have a rotation, right? Um, it's like I don't know if it's one principle or physics or chemistry, but you do know about that. Matter, it's not created or destroyed, it's just transformed. It's kind of the same in markets from time to time. Money just don't disappear. They move from one asset to the other. Right? The flows just move around. And it could be when you see a rotation, this is basically the very best example of that principle that you can have applied to markets. Now note that I noticed that I said markets. I didn't say money, because money can actually appear and disappear. They can be created and they can be destroyed. Uh, how do money gets destroyed? Well, since money are all, or the majority of them, lent out into existence, if you have a deflationary event, a credit event, that's money destruction. So that would impact market as well, right? But just a subtle difference in between money in a vacuum when you think about money and flows and funds in a specific asset class or a market, and when you think about money in general, right? They're not necessarily interconnected, although I would say money destruction would actually impact markets. But markets rotations, they don't necessarily impact the amount of money or currency units in existence or circulating, right? Just as a little aside. So let's close down the whole by looking at let's look at Nvidia being the first company ever reaching what was that? There was a four. I don't remember if it was a 4 trillions. I would guess 4 billions wouldn't make news, right? I guess it was 4 trillions market cap. So another record for Nvidia. I remember I recorded a video back then when we got that correction. There was a little bit of pain, especially in these tech stocks. There was DeepSeek coming out of China, and everyone was, this is it. The AI bubble is popped. Yeah, is it? So Nvidia just made new highs, so not bad. Although again, it might be due for a pullback at a point. Um, Apple not performing particularly cool compared to the rest, right? I was reading Apple is falling a little bit behind in the AI development, right? So you know you also need to consider that Apple is not growing earnings for a long time now. Um, I'm not saying it's gonna collapse, but I'm saying just you know compared to many other different companies, even if you look at it from a growth standpoint, there might be something which is better than this. Google, relatively stable, I'd say. Yeah, Microsoft on a tier again, not bad. Meta traded above all-time highs, pulled back a little bit, but yeah, kind of cool. Amazon on its way to new all-time highs. It seems so. At least, unless these apex right here, it provides a bit of resistance and we stay in this range. Um, there was a tiny little bit, a tiny piece of news as for Amazon, which in my view, it goes for all the big wholesale retailers, right? Same for, I don't know, Costco or Walmart and all the rest. It looks like they're finding a bit of resistance in the customers when it comes down to actually shop on the website or the physical stores. It ties in with the fact that consumers seem to be a bit tapped out. And the last example, in my view, which it might be nothing, right? But if you remember in the past, the Prime Day on Amazon, it was what? One day. Why do they feel the need of making four now? Hmm. Maybe because they hope that the more the promotion goes out, the more consumers might be enticed in to participate. because they look at their revenues, or they look at their inventories, and they see a little bit of a uh, situation which is getting stagnant a little bit. So consumers not really bidding up that much, or at least as much as they were in the past, right? Tesla, whoa, Tesla. I mean, it's hard for me to assess Tesla, especially because a lot of what you see might be driven by the arguments that, that Elon Musk might have or not have in the future, as he had in the past with President Trump. So, but again, just to look at least the Mag 7. Now, you might want to check the semiconductors, which I think are performing particularly well, like Palantir. AMD is trying to recover, but Broadcom, new all-time highs. ASML, a lager, but Taiwan Semiconductor Manufacturing, new all-time highs. Qualcomm, a lager, not a huge, but ARM still ranging. Intel, to me, unless they do change something in what they're doing, I think they're really losing market share. I mean, actually, they have lost it over the last, I would say, few months, if not years at this point. But yeah, not cool for Intel. So again, let's close down the hole by looking at volatility now, which is particularly subdued. And again, although the market is going up, it's going up with slowing down volatility. And at a point, it's going to have to expand because that's just the nature of it. It contracts, it expands, and whatnot. Usually, when it expands, it's not a good sign. You usually see it on pullbacks or retracements or whatnot. So keep it in mind. But what I wanted to do actually is having a look at these first. So as for, since we have mentioned volatility, you look at the total put to call ratio, still particularly low. And again, this ties in very well with the market being a little bit on the complacency side. Nobody feels the need to hedge themselves. And it's usually, when the market tends to surprise people to the other side, right? As for what the break evens, as for inflation, they ticked up a little bit, kind of reflecting what went on in the yields. So no divergences this time, which is again another sign that maybe the market is saying what's going on from a regulatory standpoint, from a policy standpoint, and they're pricing in a bit more of inflation in the future. I still think it's not going to be sustained, but that's just me. We will need to review that in another 6 to 12 months, and we'll see. GDP now, just for the sake of completeness, nothing new. Stayed flat with the recent data, which again, relatively flat week from the economic calendar standpoint, so not a lot. Fed Watch still pricing in no cut for July, as you can see. So yeah, look, let's just have a look at these. I got a bunch of slides just to reiterate the fact that the rally has been driven by the Mag 7, as you can see, or at least it was a Mag 7 comeback, right? Of course, do you remember I mentioned high beta versus low beta stocks? Now, Mag 7s are particularly high beta, right? And I know the majority of you probably already knows, but for those who don't, when you talk about high beta and low beta, and again, I'm not going to pretend that I'm a huge math expert, but just look at it like this. You can think at the beta as the relationship in between the movement or the volatility of a stock relative to the overall and broad S&P index. So a high beta stock will move a lot. Well, I mean, it depends on the number, but it will move a lot more or a lot less compared to the index, depending on what type of beta it has. So let's put it in very simple numbers. If you got a stock which got, let's say, a beta of 3 compared to the S&P, that means that if the S&P is up 1%, that stock is going to be up 3%. If the S&P is down 2%, that stock is going to be down 6%. Did I say the beta of what? I just forgot. But anyway, even if I just completely forgotten all the rest while I was speaking it out loud, you got the gist of it. The higher the beta, the higher the movement compared to the S&P will be. The lower the beta, the lower the movement that the stock will experience compared to the S&P. So you've seen that after Liberation Day, the Mag 7 took a much bigger hit relative to the S&P because they are high beta. So if the S&P was down maybe 20%, a few of these stocks, they might have been down 30, 40% maybe, right? But then when they recovered, you can see that they catched up, they closed down the gap, and now it looks like they are trying to take the lead once again, right? So AI bubble, United States exceptionalism are defeated and over. It doesn't look so to me, right? These are still on the planet those companies which are generating the most revenues ever, all right, and therefore earnings. Now, oh right, speaking of earnings, right, you see that the Max 7 are really driving the earning per share exceptionalism in the US compared to, especially if you look at the rest of the world, right? So this is, I don't know if it's an ATF, but when you read ex-US, it means excluded or excluding US. You can see that just the Max 7 alone are vastly outperforming the rest of the world, right? Now, speaking of iBeta, you can also think of them similarly to the momentum stock, right? You can see that now momentum and high beta, right? They're particularly elevated, while the rest of the market it's not really catching up. So on one side they are driving the market higher, but it also means that, as we said, if for some reason, again, could be Trump, a renewed fear of tariffs, because we are reaching into that deadline, which is supposedly at the beginning of August, right? Let's say Trump wakes up and after talking about 35% tariffs on Canada, next one it's the EU, 35% on the EU, right? It could get to market, right? And I'm gonna explain that in a minute. But these type of divergence, it would be just another catalyst for a potential pullback in the S&P if a catalyst happens. Again, if a catalyst happens or manifests itself, doesn't say or doesn't mean go sell everything. We're gonna pull back 10% next week. No, I'm just saying these are the risks you need to pay attention to. The technicals are not suggesting a pullback, but there are underlying risks potentially, right? If anything, the technicals are just showing you a little bit of an overstretched market, right? Um, this is another one which might be interesting. The amount of margin debt as the percentage of the real disposable income. And again, you see that when it goes particularly high, it tends to coincide with pullbacks in the market. And again, why is that? Just a little bit of anticipation. Because if you have less disposable income, or you need to drastically reduce it because maybe you suffer a margin call on your margin debt. Namely, it could be you now being forced to pay down your student loan after the moratorium, or maybe you maxed out your credit card and you cannot swipe it to go shopping around, and actually the credit card company is coming to reappropriate the funds, right? You're going to reduce your disposable income. If you cannot have disposable income, you're not going to be able to spend. If you cannot spend PCE on aggregate, which will, will just come down. If people spend less, companies will generate less revenues. Less revenues, lower earnings. If earnings get lower, PCE, so no PE, price to earning ratio, it's going to skyrocket in the sense that you know the valuation of those stocks relative to the earnings are going to skyrocket, and therefore they're going to be massively overvalued, and someone might feel the need of repricing those stocks lower relative to the earnings and the valuation, right? In a nutshell. Now, we were talking, as you've seen in here, right, about the red line and the purple line. the so-called golden cross. Now, this is just, I mean, take a screenshot of it if you want. I'm not going to talk of it too much, but this is what the S&P historically does after you have a golden cross. So again, this should be a bit more on the bullish side, especially in the long run. So 3, 6, 9 months. It doesn't tell you a lot on the very short term, but might be an indication. Sure, it doesn't tell you. I mean, maybe I guess it tells you more of the bearish cross or the death cross, because if you check when we got the death cross, at least for the S&P, it was right at the lows. Imagine selling that, right? So again, just take it into context, right? Then a little bit of a seasonality, as you can see. July tends to be okay, actually a good month, but as I was saying, with the market overstretched, with the economic data not being particularly, you know, uh, huge, getting into August, September, it might be over the next month, 2 months, we see a pullback. Uh, I guess a huge catalyst for it. It might also be earnings, right? But one step at a time. Another one for volatility, and even if you look at volatility from a seasonality standpoint, you see July tends to be particularly low volatility month, right? But then August, September, historically, again, you see volatility spiking. So seasonality says that returns are not the best. Volatility historically tends to spike a little bit, and we know volatility tends to spike when we got a bit of a pullback. So could you try to build up a case for a potential pullback over the next month or 2 months throughout the summer, right? Just because you build up a case and just because historically it seems to suggest that doesn't mean that, you know, this historical reality it's going to manifest itself even this year. Well, no, it's like everything, it's statistic, right? Over a long run, over a long period of time, it just helps you out to assess the probabilities of something happening over something else. It doesn't tell you for sure, right? Then what we got, again, a few other potential risks. Basically, I guess it's what I highlighted throughout all my jabber jabber right here. But what you see in red and green, these should be the money flows. So the amount of money flowing into the S&P for now, paired up with, I guess, this should be the red line. It should maybe it's a measure of breadth of the market. Could be mm, could be the amount of stocks above the 200 days moving average. Maybe. All right. I don't know for sure, but anyway, you see, seasonality turns weaker. Late July, August, September. Got it. Earnings. Um, you know, I think it's going to be interesting to look at earnings. Not that much the actual numbers, but the guidance. We've seen a few companies actually stopping releasing guidance because they it's not a good sign usually when a company starts to not give out guidance for or outlooks for the next quarters or months, right? Volatility, yeah, low, but yeah, as we were saying, if volatility is low, it's set up to contract and expand. So yeah, it's basically the same. Maybe it was really breadth, right? Breadth remains narrow. Yeah, again, as we've seen previously, mega cap are leading the market up, but there is a divergence. Yeah, okay, so a bit of what we've just said. This is interesting. You see earnings for Q2, uh, they have been revised lower. So again, even the analysts actually forecasting earnings are, you know, taking down the bar. On one side, it might be easier if the threshold or if the expectations are low to beat them. And therefore, being all cool, yeah, we beat expectations once again, and the market's going to rally, right? On the other side, if you look at it from a much more fundamental type of view, it could be that earnings were, or at least earnings expectations were too high. Forward earnings expectation were too high, and now they need to be adjusted down a little bit to reflect economic realities. And you remember we've been talking about the labor market, consumer spending, and whatnot. Talking about these earning per share and the annual change in it. If you compare them with a composite economic index, you see that basically economic activity drives earnings and earnings per share. Because again, if you don't have economic activity, you don't have, as we were discussing before, people with what? Personal disposable income. Therefore, people able to spend, an increasing PC, and therefore boosting up the revenues and the earnings of the companies, right? So that's just an economic reality at a point. Now, again, we might talk about fundamentals all you want, and since we were talking about disconnections and divergences, right? And I said I got a slide for it. This is it. There is a disconnect between the Fed expectations and the equity market. So, you know, you see that basically the I know it might be a bit complicated, but the swaps, the forward swap market, it's kind of telling you a story going to the downside. While instead, if you check the US cyclical versus defensive, um, it's basically a ratio of the stocks that you expect to perform better in a bull market versus defensives, which are actually the ones that you buy when the market is suffering at a downturn or whatnot. This ratio is now in favor of the cyclical, and the defensive are a little bit left in the dust. And again, it ties in with the put to call ratio being low. No one is really feeling the need of edging themselves, being a little bit more defensive, right? Everyone is just greedy as fuck as the market will go up and up and up from here till eternity. So again, there is a little bit of a disconnect even in here. And again, it reflects just the disconnect in between what the stock market is telling you and what maybe the labor market is telling you. It's kind of the same, right? Um, so, again, another one we were talking about consumer spending, and therefore, if you can see, it's just reiterate the fact that company earnings comes out of consumer spending. If consumers cannot spend, company won't generate revenues and earnings, right? Same as usual. So, you know, I guess this is it. Don't want to dive into other things. Again, as usual, for being a week where we didn't have a lot from the economic calendar standpoint, um, I had the time to look at many other different things because that's what you want to do. I mean, if there is nothing else to be worried about, why don't you go out and start to investigate other things, right? That being said, this is all for this week. I hope you're going to have a nice rest of your Sunday and potentially a good start of next week on Monday. Bear in mind, next week we are going to have, guess, on Tuesday this time around should be CPI. Yep, there you go. And then you're going to have PPI, of course, following up on Wednesday. Thursday, your usual, you know, jobless claims and all the rest. But there should be retail sales somewhere. Yeah, there you go. On Thursday. Okay. And maybe Michigan consumer sentiment on Friday. Yeah, there you go. So again, next week it's a bit busier from the economic calendar standpoint. So we'll see what the data will bring. Up until that point, hope you're gonna have a fantastic day. And as usual, be nice and be cool. Neil's out.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.